Let's assume you followed the advice of the pro traders and you placed a forex trading position with a stop loss order and a profit target. Lo and behold, price decided to move against your trading position to take you out of the market with a loss when it hit your stop loss order. But just moments after that happened, price decided to move straight through what would have been your profit target. If you didn't have a stop loss order, you would have gotten out of the market with a profit from this trading position when price decided to reach its profit target. Now, when this happens a couple of times, especially when it happens in a row, it can really mess with your forex trading psychology. And more often than not, this usually leads inexperienced traders into thinking that they would win more trading positions if only they traded without a stop loss, and that's the thought process that usually leads to the deadly forex trading mistake of. If you're still struggling to become a consistently profitable forex trader, then guess what? I've got good news for you. In this video, I'm going to teach you exactly how to stop making the top 5 deadly beginner forex trading mistakes which are preventing you from becoming a consistently profitable forex trader. But first things first, make sure to subscribe to the channel now so you don't miss out on my next video where I'm going to show you how to create a bulletproof forex trading plan and exactly how to use it to turn your forex trading performance around for the better. And just so you know, the video you're watching now is part of the videos in our free Profitable Forex Trading Blueprint series, which is a crash course designed to help you go from being a losing forex trader to a consistently profitable forex trader in a step-by-step manner. In the previous video in this series, I introduced you to the 4-step process of our profitable forex trading secret formula, which is the APTR framework. This video is meant to help you apply the tips and tricks of the first step in our simple 4-step process like a pro trader. So if you just stumbled across this video and you'd like to get instant access to the other videos in the crash course as well as the supplementary materials which come along with it, head on over to www.fxmindtricksacademy.com/blueprint or click on the link in the description of this video. By the end of the course, you'll know exactly what you'll need to start and stop doing in order to become one of the lucky few consistently profitable forex traders who are able to squeeze profits out of the spot forex markets like a broken ATM machine. So if you haven't already, be sure to check it out right away. If you're anything like the rest of us, I'm pretty sure you got into forex trading with one goal, which is to make money. However, somewhere along the line, you probably lost sight of that goal and you started making all sorts of beginner forex trading mistakes, which ended up preventing you from doing the things you're supposed to do in order to become a consistently profitable forex trader. My goal with this video is to show you the deadly forex trading mistakes which are preventing you from becoming a profitable trader and exactly what to do to join the ranks of the world's lucky few consistently profitable forex traders in no time. In case you didn't know, one of the most common mistakes which the losing majority of forex traders make is letting their losses run. You'll often hear losing traders saying stuff like,
"Real traders don't trade with stop losses."
But in my humble opinion, that couldn't be further from the truth. Unless you're using asymmetric compounding, you should never risk more than 1% of your forex trading account's capital on a single trade ever, especially if you're still struggling to become profitable. At this point, I'm pretty sure you're probably wondering why the losing majority of traders make this deadly forex trading mistake, right? Well, let me give you an example which is hopefully going to help you understand the reason why inexperienced traders often make the mistake of letting the losses from their losing trades grow out of proportion. Let's assume you followed the advice of the pro traders and you placed a forex trading position with a stop loss order and a profit target. Lo and behold, price decided to move against your trading position to take you out of the market with a loss when it hit your stop loss order. But just moments after that happened, price decided to move straight through what would have been your profit target. If you didn't have a stop loss order, you would have gotten out of the market with a profit from this trading position when price decided to reach its profit target. Now, when this happens a couple of times, especially when it happens in a row, it can really mess with your forex trading psychology. And more often than not, this usually leads inexperienced traders into thinking that they would win more trading positions if only they traded without a stop loss, And that's the thought process that usually leads to the deadly forex trading mistake of letting losses run. But as you'll see in just a moment, moving your stop loss when price approaches it or trading without it altogether is a very dangerous thing to do, because more often than not, it would lead you to blowing your forex trading account. All it would take is one or more oversized losing forex trading positions to wipe away the profits from your winning trades or your hard-earned forex trading capital altogether. As you can see on the screen, this is the My FX book stats of a completely blown forex trading account. Moments ago, I told you that one of the things you would need to do to become a consistently profitable forex trader is to learn from the mistakes of the losing majority of forex traders and do the exact opposite of what they're doing. If you take a close look at the stats from this forex trading account, you'll notice that the value of its average losing trade is much larger than the value of its average winning trade. As a result of this, it was almost impossible to make money on this forex trading account in the long term, even though it had a win rate of about 66%. To help you understand this better, imagine that you and I decided to do a little coin flipping game. I chose heads and you chose tails. According to the rules of the game, whenever a coin is flipped and it lands on heads, you're going to give me about $6. However, if it lands on tails, I'm only required to give you about $2. Now, since there's a 50-50 chance of a coin landing on either heads or tails after every coin flip, which one of us do you think is going to end up making money after, say, 100 coin flips in this game? Well, of course I am. And that's simply because the game was rigged against you from the get-go. If you won 50% of the time, and I also won 50% of the time, after 100 coin flips, I would end up with a net profit of about $200 simply because I got more money from you when I won a coin flip than the money I had to give you when I lost. And this is why it's so important to make more money from your winning trades than the amount of money you're going to lose from your losing trades on average. I can't stress this enough. You could have a win rate as high as 90%, but if your losses are much larger than your wins on average, chances are pretty high that you could still end up blowing your forex trading account. The only time you're going to be able to make money through forex trading with your average loss being larger than your average profit is when your win rate is higher than 95%, for example. Remember when I told you that you shouldn't risk more than 1% of your forex trading capital on any single trade unless you are practicing asymmetric compounding? Well, 1% of this account's starting capital would have been $1,000 since the account was a $100,000 account. However, when I click on the history tab of this forex trading account and sort its net profit column in descending order, you would notice that the value of its largest losing trade was as high as $63,220 which is about 63 times the maximum risk per trade which was supposed to be taken on this forex trading account. This makes it pretty easy for us to see why this account ended up getting blown. Also, if you take a look at the stop loss column of the trades which were taken on this trading account, you would notice that this trader was also trading without a stop loss at some point. This is also part of the reason why their losses grew out of proportion. Trading without a profit target is fine if you're trying to let your profits run and you're not getting greedy, but trading without a stop loss is a complete no-no. On the contrary, if you're trading without a profit target, just make sure you've got a rule-based exit plan for getting out when price decides to move in favor or against your trading position so that you know exactly when to get out. Personally, I do not recommend discretionary exit strategies because of their subjective nature. I've also found out that traders are much more susceptible to making trading errors using discretionary trade exits when they're facing a winning or losing streak. So no matter what you do, cut your losses short and never trade without a stop loss, or a mental stop loss in the very least. And you should also avoid adding to your losing forex trading positions at all costs because that could lead to devastating losses which could be pretty hard to recover from. Cutting profits short is another deadly beginner forex trading mistake you'll need to avoid at all costs. If you've been trading for a while, I'm pretty sure you must have heard pro traders saying things like you should always trade with a favorable risk to reward ratio if you would like to make money online through forex trading. You know, basic stuff like risk 1% of your forex trading account's capital, while aiming for something like a 2% return on investment if or when a trade you take ends up being a winner. That's actually a pretty good forex trading advice, but wouldn't you like to know what's even better than that? Well, the only thing that's better than having a favorable fixed risk to reward ratio, such as 1:2, 1:3, or even 1:5, is having an unlimited risk to reward ratio where the size of the profits from your winning trades are only limited by the market's price action. This is why you'll often hear the professional traders in the financial trading industry telling you to always let your profits run. When you're cutting your losses short and letting the profits from your winners run, you'll only need to catch 1 or 2 large winning trades to make up for a handful of losses which you would have incurred from your losing trades. This is why letting your winners run is so important. To help you understand this concept better, try to think about it this way. If you were trading with a 1:2 risk to reward ratio, you would only need a 33% win rate to break even. But anything above a 33% win rate is going to stack the odds of making money in your favor simply because your average winning trade would be twice the size of your average losing trade. But what if you were trading with a 1:5 risk to reward ratio? Well, in that case, you would only need a 17% win rate to break even, and anything above a 17% win rate is going to put you in the green. I hope you're beginning to see how cutting your losses short and letting the profits from your winning trades run can give you an unfair advantage over the markets. Another pretty common beginner forex trading mistake which usually stands in the way of profitable trading is poor risk management. Almost every retail trader I've come across has tried to get rich through forex trading at some point in their lives. Trust me, I've had my fair share of blown forex trading accounts simply because I failed to practice proper risk management. Poor risk management is usually the result of taking oversized trading positions with little trading capital on an over-leveraged forex trading account. And without a shred of doubt, poor risk and money management is one of the most common mistakes which causes inexperienced forex traders to blow their forex trading accounts. So why do traders fall victim to this notorious rookie forex trading mistake? Well, to put it in simple terms, forex traders who practice poor risk management usually find themselves doing that as a result of trading with emotions such as greed and fear. When rookie traders are experiencing a winning streak, they usually tend to get greedy and overconfident, and this usually causes them to take huge risks on their forex trading accounts. On the flip side, when these traders are going through a losing streak, they tend to become snakebite fearful, which consequently leads them to taking very small trading positions simply because they're afraid of losing money. To help you understand just how dangerous the effects of trading with poor risk management is, imagine you were trading on a $10,000 forex trading account. And as fate would have it, you just found some super powerful forex trading strategy after snooping around the internet for a while, and the last 9 trades you took using your newly found forex trading strategy all turned out to be winning trades. Words cannot even begin to describe how happy you are, and a part of you has even started to think that there's just no way to lose money trading the forex markets using your top secret forex trading strategy. And so you decided to bet the farm on your 10th trade using that trading strategy. On the last 9 trades which you took using the strategy, you were only risking 1% of your $10,000 forex trading account. And since you were trading with the 1:2 risk to reward ratio, your account is now up by about 18%. But after having a feel for the spectacular results of your top secret forex trading strategy, you decided to risk $5,000 on your 10th trade because you were feeling lucky and you just desperately needed to make 10 grand at that particular moment in time. But guess what happened? That trade turned out to be a losing trade. In this example, you did everything your trading strategy told you to do except risking no more than 1% of your trading account's capital per trade. And as a result of that, you've now lost a huge chunk of your forex trading capital instead of being in the green simply because you failed to practice proper risk management. At this point, The fact that you had a 90% win rate over the last 10 trades you took doesn't really matter, simply because poor risk management caused you to lose all of the profits from your past winning trades as well as a huge chunk of your forex trading capital. On the other hand, the fear of losing money causes plenty of struggling forex traders to risk a lot less per trade than they usually do whenever they're experiencing a losing streak. Now, even though a lot of traders would argue that this is the right thing to do, the problem is there's no way for us to know when a losing streak is going to come to an end, since the distribution of winning and losing trades are random. As a result of this, the profits from the winning trades which these traders would take with very small risk towards the end of their losing streaks would not be enough to make up for the losses which they would have incurred from their losing trades. Again, to help you understand this better, imagine you were trading on a $10,000 forex trading account and you are risking 1% of your trading account's capital on each trade you took. However, after taking about 7 losses in a row, you decided to cut down your risk per trade to about 0.25% of the initial balance of your forex trading account's capital. And as fate would have it, the next 3 trades you took on that forex trading account all turned out to be winning trades. Now, since you were trading with a 1:3 risk to reward ratio, each one of those winning trades brought in a profit of about 0.75% of your $10,000 forex trading account's capital. After adding up the profits from those 3 winning trades, you'll end up with a gross profit of about 2.25%. But when you add up the losses from those 7 losing trades, you'll end up with a gross loss of about -7%, since you are risking 1% of your trading account's capital on each one of those trading positions. In this example, the profits from your winning trades are just too small to make up for the losses from your losing trades. But if you hadn't cut down your risk per trade from 1% to 0.25% when you were going through that losing streak, the profits from your winning trades would have been more than enough to make up for the losses from your losing trades. And this is simply because if you were risking 1% per trade and aiming for a 1:3 risk to reward ratio, the gross profit from the 3 winning trades which came at the end of the losing streak would have been 9% instead of the 2.25% you got after lowering your risk per trade. And this is one of the reasons why you need to stick to a fixed risk per trade whether you're going through a winning or losing streak. The only exception to this is when you're practicing asymmetric compounding with a profitable forex trading strategy. The excruciating pain of poor risk management usually causes a lot of traders to become excessively fearful of losing money. In fact, for some forex traders, there are times when their fear of losing money is so intense that it would even prevent them from placing the trades which perfectly fit the rules of their forex trading strategies. And more often than not, the trades which these traders fail to take usually turn out to be profitable trades which would have made up for a huge chunk of the losses from their losing trades. This would have been completely avoided if only they took the time and effort to practice sound risk and money management. The reason why I took my time to explain this to you is simply because proper risk management is one of the most important things you'll need to do on a regular basis if you would like to become a consistently profitable forex trader. If you're just starting out, try to risk no more than 1% of your forex trading account's capital on each and every trade you take. Another pretty common mistake which beginners and struggling intermediate forex traders tend to make is jumping from one trading strategy to another as soon as they begin to experience a losing streak. They fail to realize that almost every forex trading strategy on the face of planet Earth has got times when it's going to go through both winning and losing streaks. For example, trend trading strategies would perform exceptionally well when the markets are trending, but they'll struggle to turn a decent amount of profits when the markets are ranging or consolidating. On the contrary, strategies which are designed to exploit range-bound market conditions are going to perform much better than trend trading strategies when the market isn't trending. However, those same forex trading strategies are probably going to put up their worst performances when the market is trending. In the same vein, mean reversion and counter-trend trading strategies are going to do pretty well when an overextended trending market begins to retrace. Forex trading strategies which were designed to take advantage of these market conditions are going to give you a higher number of winning trades when the conditions which they were designed to exploit are present within the markets. Likewise, Counter-trend trading strategies are probably going to give you a higher number of winning trades when an overextended trending market begins to enter into a corrective phase. But that same strategy might have a pretty hard time picking winning trades when the market is experiencing a really strong trend. And this is part of the reason why rookie forex traders find it hard to stick to a forex trading strategy through thick and thin. These guys will be the first to dump profitable forex trading strategies as soon as they give them a couple of losing trades when the market conditions which those trading strategies were designed to exploit temporarily leave the market. More often than not, these traders will begin to doubt the profitability of any forex trading strategy as soon as it begins to give them a couple of losing trades, even if they've rigorously backtested that forex trading strategy beforehand. They'll once again embark on that never-ending search for the holy grail forex trading strategy which is going to give them winning trades 100% of the time, even though they might not want to admit that to themselves. They'll keep jumping from one forex trading strategy to another simply because they're afraid of being wrong. These types of forex traders secretly want each and every trade they take to turn out to be a winning trade. Their inflated egos and excessive need to be right is what's preventing them from accepting that trading is a game of probabilities and not a right or wrong game. The funny thing is, you can be wrong 7 times out of 10 and still make money through forex trading with an average forex trading strategy as long as you're trading with a modest risk-to-reward ratio and a rock-solid risk management plan. So don't let this common beginner forex trading mistake prevent you from becoming the consistently profitable forex trader you've always wanted to become. Here's a trick question for you. Would you start a business without a business plan? I hope the answer you gave to that question was a no, because any smart business person would tell you that starting a business without a plan is a recipe for disaster. Failing to plan, they say, is planning to fail. But you'd be surprised to know that trading without a written plan, which clearly states exactly when, where, and how to get in and out of the markets, is one of the most common mistakes beginners tend to make in the forex trading industry. A lot of inexperienced forex traders base their trading decisions off of hunches, tips, and gut feel, which makes it extremely difficult for them to make money online through forex trading on a consistent basis. If you would like to succeed in this business, you're going to need to craft a forex trading plan which is going to dictate exactly what you're going to be doing in the markets. From how much you're going to risk per trade to exactly when and where you're going to be getting in and out of the markets with your forex trading positions. Trust me, you'll hardly come across a professional forex trader who doesn't have a clearly defined forex trading plan which tells them exactly how to go about managing their forex trading business. The traders who succeed and make money through forex trading on a consistent basis are the ones who treat it as a business. And having a clearly defined and properly executed forex trading plan is definitely one of those things which separates the professional traders from the losing majority of forex traders. If you'd like to realize your dream of making money online through forex trading, you'll need to start treating forex trading as a business and quit fooling around like the losing majority of forex traders. Get yourself a proven step-by-step forex trading plan which is going to tell you exactly how to go about trading the spot forex market and do exactly what it tells you to do. Nothing more, nothing less. And now it's over to you. Which one of the 5 dangerous beginner forex trading mistakes which we talked about in this video have you found yourself guilty of committing over and over again? Do you find yourself taking huge losses because you keep moving your stop losses away when price approaches them? Or do you just shoot for the fences and risk a huge chunk of your trading account's capital on a single trade? I'd like to hear from you in the comments section. In the meantime, if you don't have a forex trading plan and you don't want to go through the stress of creating one from scratch all by yourself, click on the video on the screen now to get instant access to our foolproof 3-page forex trading plan, which is going to help you to improve your forex trading performance by leaps and bounds beyond your wildest imaginations.